Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 11th August. Coming up on the show, Nvidia and AMD agree to give 15% of their China chip sale revenues to the US government, as Intel's boss readies himself for a meeting with President Trump. The crypto rally continues. Bitcoin is closing in on yet another record high. And as talks aimed at ending the war in Ukraine look set to start, defence stocks come under pressure. We'll have all the details. So grab your coffee and let's own the morning. OK, before we kick off the things you need to know before the opening bell rings, let's take a look at where US futures stand. So, well, it looks like Wall Street's bull run looks set to continue. Remember, last week, the Nasdaq hit 2 consecutive record highs, while the S&P 500 narrowly missed its own record high on Friday. Big tech was firmly in focus last week, with Apple posting its best week since 2020. And our first thing you need to know before that opening bell rings is again focused on tech. In what can only be described as an unusual agreement, Nvidia and AMD have agreed to pay 15% of their China chip sale revenue to the US government. Why? Well, it's seen as one way the firms can secure export licenses from the Trump administration that were granted last week. Shares of both were down in the pre-market, as you can see here. Now, Nvidia will give a share of its revenues from the sale of its H20 chip sales in China, while AMD will do the same for the sale of its MI308 chips. The arrangement reflects US President Donald Trump's consistent effort to engineer a financial payout for America in return for concessions on trade. His administration has shown a willingness to relax trade conditions like tariffs in return for giant investments in the US. Beijing, which has grown increasingly hostile to the idea of Chinese firms deploying the H20, is unlikely to warm to the idea of a chip tax. Well, we're staying with chips for the next thing you need to know before that opening bell rings. Intel CEO Lip-Bu Tan is set to meet US President Donald Trump at the White House later today. They're going to be discussing cooperation between Intel and the US government. The Intel boss's personal and professional experience is also likely to come under the spotlight. Remember, last week, the president called for Tan to resign amid suspicions of a conflict of interest. And remember, Trump ally Tom Cotton sent a letter to the Intel CEO questioning Tan's investments in Chinese companies. And the final thing you need to know before the opening bell rings is that Chinese electric battery manufacturing firm CATL has suspended production at one of its lithium mines in China. The move came after its mining license expired on Saturday. This sent the price of lithium futures soaring in China, as well as stocks related to the metal needed to run electric cars. Now, with stocks getting back to record highs, there are a number of earnings and economic data points to watch out for this week, which we'll be covering on Yahoo Finance. My colleague Josh Schaefer has the details.
It's time now for What to Watch. Starting off on the earnings front. Earnings season raging on with reports coming in from CoreWeave, Circle, and Cisco, among others. Cisco announcing results for the fourth quarter after the market close on Wednesday. The company's 2026 forecast will be in focus for investors when it reports those earnings. Analysts expecting strong demand for its AI-related products, which could push sales toward the top end of its fourth quarter guidance. Taking a look at the economy, we're getting a key piece of data on Tuesday with CPI. That's the Consumer Price Index. Economists forecasting total CPI, headline CPI, to fall 0.1 percentage point to 0.2%, and core CPI to tick up to 0.3%, those on a month-over-month basis, giving us more insight into inflation as the Fed maps out the future interest rate path. Moving over to the Federal Reserve, some fresh commentary from multiple Fed officials coming throughout the week. This coming after President Trump posting on Truth Social on Thursday and nominating Stephen Miran, Council of Economic Advisors chairman, to serve in Fed Governor Adriana Kugler's seat as a Federal Reserve governor.
Okay, for market movers, we're going to look at some of the impacts the talks between Russian President Vladimir Putin and his US counterpart Donald Trump are already having on the markets. Our primary focus is defence stocks, and in particular, European ones. Just look at how they're trading this morning. The fall is led by giant German firm Rheinmetall. They're down over 4%, as you can see. Now, these stocks all got a boost back in June when NATO leaders agreed to further ramp up defence spending. The large majority committed to increasing defence spending to 5% of their country's GDP by 2035. However, the losses just after the opening bell rang across Europe were even steeper than what we're seeing right now, and there may be a sense that some traders have dialed back their optimism that a summit between Trump and Putin would bring the war in Ukraine closer to a resolution. That may be because Ukrainian President Volodymyr Zelensky still refuses to give up any land. Another big impact has also been seen in the oil markets. Oil prices extended last week's more than 4% decline. These talks between Russia and the US follow increased pressure from Washington about raising the prospect that penalties on Moscow could also be tightened if a peace deal is not reached. Now, President Trump set a deadline of last Friday for Russia, which invaded Ukraine in February 2022, to agree to peace or have its oil buyers face secondary sanctions. At the same time, Washington is pressing India to reduce purchases of Russian oil. However, the president didn't reveal any new measures. Oil has lost more than 10% this year as the oil cartel OPEC Plus brings back production faster than initially planned, ending curbs made in 2023, even as slowing economic growth threatens to cut consumption. A peace deal with Ukraine could see an end to sanctions on supply from Russia, removing the risk of disruption to Moscow's flows after Trump's comments in recent weeks that he would put measures in place against its biggest buyers. Another area where details are lacking are in the recent trade deals Washington has struck with a number of countries. Yahoo Finance's Ben Werschel has more.
We have these reciprocal tariffs that are now in place, built around 10 to 20% duties on countries that have a deal. On the other side, on the parallel track, we have these deals that are under increasing confusion. Basically, what's in them? We don't have legally binding text on any of them. We don't even have joint statements on a lot of them. And what we've seen is a lot of issues arise on what's there. The main one is whether these rates that we're seeing that went in place this week are all inclusive. In other words, does a 15% deal with Europe mean 15% on semiconductors? Does it mean 15% on pharmaceuticals and autos? Even the White House fact sheet on the deal says yes, but a variety of actions and words from the Trump administration this week have raised questions. We even saw the Japanese trade negotiator make a quick trip to Washington this week, basically to get reassurance on that front. He came out saying that he's confident it's going to be resolved. This is a sort of temporary issue, especially on autos. That's a giant issue for him. After all this negotiation to get it down from 25 to 15%, at the moment, the tariffs are still at 25% on autos. The other aspect of this is these investment deals that we're seeing in there. Trump describes them as a blank check for him, basically for him to decide what to do with, a pot of money. These other countries describe these very differently, more like a financing fund. This is all important because a third aspect of these deals is Trump constantly saying he reserves the right to change any terms he wants if he feels unhappy. He can raise the rates if he wants to. He says he has the right to do that if this isn't working out to his liking. So the bottom line for folks is that even though we have all these deals and we've had all these high-profile announcements, these are very fragile agreements as we are still waiting on legally binding text, which by all indications is still being worked out on all these fronts.
Okay, we're heading for a quick break now, but coming up, we'll take a closer look at the IPO market. Stay tuned to Market Sunrise. Welcome back. And you may have noticed this year, new IPOs in the US are crushing it out of the block. Just last week, Firefly Aerospace closed its first day of trading up 34% from its IPO price of $45. It's fallen back since, but is still in the green since it started trading. And some other big IPO names you may have heard of are Figma, Chime, and Circle. In total, in the second quarter, 59 US IPOs raised cumulatively more than $15 billion. That's according to S&P Global Market Intelligence data. So, as investors' demand and expectations build up for the second quarter, how should you play the trend? Avery Marquez, the Director of Investment Strategy at Renaissance Capital, shared her investor playbook with Julie Hyman on Yahoo Finance's Market Catalyst.
The IPO market has been very slow the last few years. So public investors have really been starved of these high-profile IPOs. And now that they're coming back, we do see this, as you mentioned, very high pricing and very strong demand on day one. But that doesn't necessarily mean that it was maybe priced incorrectly. But that's where investors are indicating their demand. So in this case, I think it really is, yeah, just that pent up demand and maybe a little bit of hype and FOMO returning to the IPO market.
Yeah, definitely. We've seen signs of that elsewhere, of course, as well. Are there particular types of IPOs that have proven especially popular?
Tech is the big one. We saw that with Figma. We've seen that with eToro and Mountain, definitely with Circle, if you, I guess, count that more as tech, fintech. Yeah, tech has been a big area. And again, that's because we haven't seen these really high profile tech unicorns for the past few years. So there is just demand for those names now that they're coming back to market. Coming back to market with perhaps stronger fundamentals than they would have had if they'd come to market back when things were very frothy in 2020 and 2021. But we're also seeing increased demand in areas like space and defense. We've seen that with Firefly and earlier this year with Carmen and Voyager. And I think that we can attribute that to kind of just sector tailwinds. We have a pretty, space and defense forward administration right now. So those are two areas that I think this year have proven that investors are eager to get in on.
So when investors are trying to figure out whether they should buy a recent IPO, what kind of criteria do you advise they look at? And are there certain things they need to consider for recent IPOs that are more relevant than they would be for companies that have been out for a while?
Absolutely. Some criteria I think are kind of basic, just strong fundamentals, compelling growth. But I think it's important for especially retail investors to remember that while missing out on a big pop can hurt, the IPO is really more than just the first day. These companies are considered new stocks, unseasoned equities for a while, 3 years by the Renaissance IPO Index's standards. So there is plenty of time after that really, very early trading period to get in on that transformative time in these companies' public lives.
When you look at the Renaissance IPO ETF, it's up, around 12-13% this year. The S&P 500 is up about 8.5%, so we've seen that outperformance. Do you think that's going to continue, and what's going to continue to drive that outperformance, if so?
Right now, I think it's hard to predict that. We have done very well, especially in the last 3 months or so, since that really strong rally in the post-tariff April period. What could continue to drive outperformance in the IPO ETF compared to the broader market indices is just going to be continued demand in the aftermarket. We see these big pops. I think those pops get investors interested. Now what's going to matter is seeing continued demand, continued interest in the aftermarket.
Okay, we'll be right back after a short break. Stay tuned to Market Sunrise as we've got our trending tickers coming up next. Welcome back to Market Sunrise. Let's dive straight into our trending tickers. Okay, we kick off with Bitcoin. The original cryptocurrency has been hovering around its all-time high this morning, and here's where it stands. It's up more than 2% at just below 121,000 US dollars. The record set in July stands at $123,205. Analysts and investors say the surge is being driven by demand from institutional investors and corporate treasury buyers, especially after the announcement that gold bars imported to the US would be subject to tariffs. And that's also pushed up a range of other crypto assets over the weekend. Another big crypto, Ether, surged above 4,300 for the first time since December 2021. And look at this one, shares in Bitmine, if I get that chart coming up, are up around 14% in pre-market trading. Up 12% now in pre-market trading, extending Friday's 25% surge. The crypto mining firm is the largest public owner of ETH, meaning its stock is tightly linked to the value of the cryptocurrency. And it's worth mentioning that Eric Trump, the president's son, who has financial interests in the sector, applauded the crypto rally on the social media X. Okay, now for our second trending ticker, we turn to a struggling renewable energy giant in Europe. Ørsted plunged more than 28% this morning. That's right, 1/4 of its total value, which is now under the $20 billion mark. What's the problem with Ørsted? Well, its aggressive expansion in the US seems to be backfiring under a Trump administration that's hostile to offshore wind. So the world's largest offshore wind developer has had to cancel some projects and is planning to raise around 60 billion Danish kroner through a rights issue. That's around $10 billion to try and shore up its finances. The company will report its latest earnings on Wednesday. And finally, let's go to Japan, where investors are really liking the latest news about SoftBank. The technology conglomerate saw its shares rise more than 10% on Friday. The rally comes amid reports that SoftBank is looking to launch a public offering in the United States for PayPay, its Japanese payment app operator. Goldman Sachs, JP Morgan Chase, and Morgan Stanley are among the investment bank's leading preparations for the potential $2 billion listing. That's according to Reuters. The news comes on the heels of a strong earnings report from the tech conglomerate, which notched nearly $3 billion in net profits in its first quarter, driven by big bets on stocks such as Nvidia. And that's not just for SoftBank. Those tech stocks such as Nvidia are driving much of the value of the S&P 500 these days. And the index now has a concentration issue that is affecting ETFs and other related products. My colleague Jared Blickery explains why you should take care. And that's the latest episode of Stocks in Translation.
The S&P 500 has a concentration problem. The most important stock index in the world is more top-heavy than it has been in the last 45 years. The 10 biggest stocks, they make up nearly 40% of the index. What's behind this mess? The rules for registered investment companies, or RICs, were created way back in the 1930s and 1940s for mutual funds to make sure they didn't get too concentrated in just a few stocks. But modern ETFs that only go back to the beginning of the century, they have to comply with them too. In particular, these so-called RIC rules, they say that no single stock can make up over a quarter or 25% of a fund. And the sum of all the stocks together making up at least 5%, they cannot exceed half of the fund or 50%. So it's great for diversification, but in a mega cap world, it forces ETFs that are supposed to be passive to dial down the biggest names. Now look at this table of 4 S&P 500 sectors and their top 3 stocks. For instance, in communication services, we have Alphabet or Google with 38%, Meta with 31%, Netflix with 10%. Add them up and you get 79%. That is way too far over that 50% that's required by the rule. And a similar thing happens with the tech sector, with consumer discretionary, and this one surprised me, even the energy sector. ExxonMobil, Chevron, and ConocoPhillips, they add up to 55%, just a little bit too high. But the bottom line is, an ETF cannot just copy and paste that concentration and still pass the RIC test. They have to cut their biggest weights. Now here is the real-world impact. In this chart right here, the performance of the S&P 500 tech sector in green, this is since the start of this bull market in October of 2022. That white line below it, that is a performance of the Technology Select Spider Fund, which we know by the ticker XLK. All you need to notice is that big gap between the two lines at the right side of the chart. XLK is up 126%, but the actual tech sector of the S&P 500, that's up 158%. And that is a difference of 32 percentage points. That's a big gap. Here is the same story in a table that shows the gap in performance for all 4 of the sectors we've been discussing over this nearly 3-year-old bull market. Tech has the biggest difference. We just took care of that. But communication services with Alphabet and Meta, that has a difference of 16 percentage points. Then you can see there's only a small difference of 3 percentage points for consumer discretionary. That's where you find Amazon and Tesla. And there's virtually no difference for the small returns in the energy sector, which is more or less traded sideways through this bull market. So here comes the fix. There are newer ETFs designed to get closer to the index concentration while remaining compliant with all the rules. This table here, it focuses exclusively on the tech sector and its 3 biggest weights. Those would be Nvidia, Microsoft, and Apple. We have the weights of each within the S&P 500, the weights within the new Global X Pure Cap Tech ETF with the ticker GXPT, and finally at the bottom we show the weights in XLK, which we've discussed has been around most of this century. Note that the new GXPT ETF gets much closer to the weights in the S&P 500 for those 3 stocks. Now, finally, this table here shows the total weight of those three stocks, Nvidia, Microsoft, and Apple, in each of the same three instruments from the last table: S&P 500 Tech Sector, GXPT, and XLK. Now, the new GXPT at 60%, it gets pretty close to the S&P 500 Tech Sector at 62%, while XLK is stuck down at 42%. Now, there is a trade-off to getting around all these concentration rules, and it comes down to fees. GXPT charges a management fee of 0.25% per year, while XLK, it's only 0.03%. That's 1/8 of the new tech ETF. So you're paying more to get closer to that concentrated index profile. I should also add that the select spider funds like XLK and XLY, they aren't doing anything wrong. They're just following the rules that they've been in place for decades. So the bottom line is, in today's market, it's built around a handful of colossal winners. In concentration, it may ease or it may stick around, but at least now you can choose how closely you want to ride with the giants. Tune in to Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
And speaking of tech stocks, there's one more ticker we are keeping an eye on today. Look at this. C3 AI was down roughly 30% this morning in pre-market after its preliminary results for the quarter came in much lower than expected. The enterprise AI software company forecast revenue of around $70 million, more than 30% below expectations, and it said it's restructuring sales. Before we go, let's take a look at the overall markets. We start in Asia. Now, it's worth noting that markets are closed in Japan today. In Shanghai, shares are higher after data showed consumer price inflation ticked up in July, but producer prices kept falling as the country's massive manufacturing sector exported deflation to the rest of the world. Turning to the US now, and let's take one look at the US futures, and they continue to inch higher. Inflation will be in focus tomorrow on what could be a really important day for the Fed and what happens to rates. And then we will look quickly at Bitcoin, which is still trading pretty high, still above 120,000, still up 2%. And finally, let's have a quick look at AMD, Nvidia, in light of our top story about the chip giants giving up 15% of their China sales revenue to the US government. Both shares down in pre-market. Okay, well, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Later today, we'll have an interview with Jim Farley, the CEO of Ford, so you want to stay tuned in for that here on Yahoo Finance. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.